Hi traders, welcome to this edition of Expert Market Analysis brought to you by Errante. This is generally a bi-weekly review and preview, so every other week of the market's key events and trading opportunities. We have had a couple of consecutive weeks of webinars actually due to all the risk events that have been taking place. So I just let you have a look at the disclaimers. I'll just run through a couple of key objectives of the webinar, really. We like to break down all the market jargon and complexities that we read about and you guys read about. So if you do have any questions, please do ask them along the way and we'll try to answer those as we go. Any question, however big, however small, please do ask them. Anything you're looking at or we talk about, of course, then yeah, more than happy to try and clarify things and explain what has been going on. We also think markets are generally driven by themes, and so we look to highlight these fundamental ideas allied to then looking at the technical moves in charts, on charts, in the markets, be it for currencies, stocks, or commodities. Okay, so it's just after 11 a.m. In London, so let's get to it. First of all, I'll just run through briefly how markets are shaping up currently, of course. And firstly, probably the key market is oil, of course, on the back of the ramping up in tensions, in escalation potential in the Middle East, of course, with Iran firing missiles at Israel, and then Israel now threatening to retaliate. Crude has jumped, of course, on those renewed supply fears after that attack and about escalation. Interesting for us that if we pull back this Brent crude chart, actually, you can see this key level here, a 72.47 in Brent crude, that is. And you can just see we have dipped below it previously, start of September, after that big sell-off in the first week or so, but then we've sort of bounced off it now, and certainly interestingly with this move higher that you can see yesterday, we actually only got well, we closed just below the weekly high, so I hadn't actually made that even on all of these tensions. Of course, now we're getting a little bit of pickup again, so potentially we are breaking those previous highs, near-term highs at least. But you know, relatively, you can see price action really in oil, really sort of hanging on China demand really, and also Libyan the restart of Libyan production really weighing on prices over and above any geopolitical tensions. Of course, that is slightly starting to change slightly, as I say, but still we're still relatively muted price action in oil. So just bear that in mind, of course. That will change certainly if Israel targets nuclear facilities or, of course, energy infrastructure facilities in Iran, then things would certainly change for oil and for probably broader markets in general. If we look at gold as well, always obviously of note during geopolitical tensions, of course, and we saw that pick up yesterday, 1% jump in gold, but it hasn't really challenged the all-time highs, of course, just yet. Those are from last week at 26.85, that record high. So yeah, just noting that high really, and whether it's a matter of time before that is challenged, of course, if these tensions continue. Iron ore, interestingly, that holds on to most of its 20% rally from last week. For equities, and we'll look at equities a little bit, actually we'll look at equities now, but if we look at the S&P 500 chart firstly, you can just see that sell-off yesterday. Just a rally in Chinese equities actually continued overnight, with Hong Kong rallying over 6% after reopening. And of course, the stimulus measures from last week, we'll just get into those shortly because we think those are very important for the market in a wider sense. The VIX, so that's the Wall Street fear gauge, that jumped above 20, but then closed just below 20, 19.64, was a 3-week high actually. Not excessively high again, with tensions seemingly so high, really saying that markets do not kind of yet envision any sort of all-out military war, really, whether that's complacency or not. But at the moment, that escalation hasn't happened by Israel, and therefore it's sort of being targeted strikes by Iran, and just a sort of show of strength similar to April, really, at the moment, is probably what markets are thinking. Just on US stocks then, they sunk from the open as really investors took flight yesterday. The S&P lost just under 1%, was actually the biggest one-day point and percentage drop since early September. The tech heavy Nasdaq, that moved, that was the underperformer, dropping just under 1.5%. And it lost as much as 2.3% earlier in the session, but did pare back some of those losses. The Dow was the modest outperformer, really. That only lost 0.41%. Energy naturally was by far the biggest outperforming sector yesterday. Utilities and communications also in the green, and then tech tumbled over 2.6%, I think, with real estate the next worst sector, losing 0.66%. So you can just see here the S&P 500, certainly the all-time highs at 57.67, you can see there. And then initial retracement level would be 56.28. That tallies with the blue line. 56.25 is the 21-day moving average, which also tallies really with these highs back in July and then back in August as well. So interesting level there. We do sell off some more, 56.28, 56.25, interesting, decent support level for the S&P 500. Just in the Nasdaq, we haven't got up to those all-time highs, as you probably know if you've been following us, and we just dipped again. Interesting fib point, the next fib point, more major fib point really, retracement level 61.8 of this is the July-August downtrend. Yeah, that 61.8 is at 19,444, tallies with the 21-day moving average again at 19,450, that is. So next level of support, major support for the Nasdaq, the tech heavy Nasdaq, of course. The Dow, interesting, that spike high last week where we got up to another record high at 42,628. You can see it was a fairly bearish candle, though. We did close higher, but closer to the lows, much closer to the lows than the highs, you can see. But interesting, yesterday again we did dip down to, well, not the Monday low, just below 42,000, but then we pushed up even though we closed lower. So probably around 41,800 support level, and then below that you've got that 21-day moving average again at 41,522. Okay, those are stocks and US stocks in particular. Just a couple of themes we want to run by you. Certainly for the yen, last Friday's LDP election, Ishiba, he emerged victorious as the ruling party leader, and then promptly sought a national election as well for the end of this month, I think. Interestingly, the dovish candidate Takaichi, she had won the first initial vote, so dollar yen actually moved higher, so the yen depreciated essentially on the dovish winner of the first round. If I just show you dollar yen, actually you can see that pop higher up to 146.49 on those results on Friday. But then obviously when Ishiba emerged victorious, then dollar yen moved lower, so the yen was appreciating. He has basically voiced support for the Bank of Japan's independence and its normalization strategy in his past, and that really suggests possibly a firmer focus on tackling deflation. Certainly could mark a turning point in monetary policy discussions, but certainly adds a sort of layer of uncertainty as well for the yen markets, looking closely at his approach to monetary policy, whether that aligns, of course, with the BOJ's, pausing so far, or potential more hawkish shift as well. At the moment, we heard from Ishiba recently, who backtracked slightly from that sort of more hawkish stance, but whether that continues over the long run, we shall see. Certainly, though, The yen is benefiting, of course, from safe haven demand. It's benefiting from, well, recently from lower oil prices. Remember, Japan, a major importer of energy, of oil. Also, dollar yen benefiting, of course, from that 50 basis point rate cut by the Fed, and then, of course, the chance of BOJ rate hikes. Of course, allied to that is, of course, if we do get a stronger yen, potentially then we get weaker Japanese stocks as well. And we did see that on Friday with the weaker Nikkei down close to 5%, I think, on the day, contrasting with the stronger yen. You can just see the 21-day moving average. That's that blue line. That's at 142.92. So we're just above that at the moment. If we just pull back, we've still got these long-term fib levels from the low in 2023 up to the high. And that halfway point, pretty much where just above where we are now, that's at 144.58. The big major 61.8 retrace levels at 140.84. You can see that cap the downside in January, and then also in September, earlier in September. So interesting levels really in dollar yen, certainly with the new potential PM Shiba coming to the fore. Also in Asia, we want to just check you're aware of course, the huge news out of China last week with their stimulus measures. On Tuesday, the PBOC, the People's Bank of China, and financial regulators, they announced a wide range of measures to shore up the ailing economy. So they had rate cuts, they had buybacks in the stock market, and also then mortgage rates on existing loans were cut as well. But then on top of that, there was a suggestion China's big banks would be recapitalized. And then on Thursday, really, it continued with China's top leaders dedicating their monthly meeting in the Politburo to the economy. And really, that has not been the case in September, and really sent a clear signal that stimulus would be stepped up across the board, and really showcasing that the economy and turning around the economy would be the #1 priority moving forward. With all the measures that have been announced, it's really the biggest round of stimulus since the current crisis started 3 years ago, kind of being called the whatever it takes moment in China policy, economic policy at least. And I know that economists watching China are now rapidly upgrading their growth estimates, really, with remembering that, of course, 5% is the target for the Chinese government. So it's just something to watch there, certainly with the moves in stock markets in China being really, really stunning over the few sessions. If I just pull up the main stock indices, which is the CS300, you can just see this huge ramp higher, 15% or so last week. I think 24% in 5 sessions, essentially. Of course, that's coming from low levels, and you can see sort of 3150 is the sort of big support level. Got down to there in January and bounced, and then got down to there again before this big, huge move higher. And we're just sort of now above the initial retracement level, 3774, and we're getting up to an interesting 38.2 level, which is around sort of 4186 or so. That'll be interesting to watch if we do get some further buying, with, of course, these measures certainly being timed, actually, as well, I should say, with the fact that China's gone into a 1-week national holiday, which started on Tuesday, yesterday. Really then policymakers hoping that the measures will lift confidence when, of course, millions of families get together across China. Okay, let's now just go to, we'll just review quickly, actually, last week's main events. Just before we get to this week's main event, of course, which will be the non-farm payroll. If we just check out the inflation data out of the US, which was the PCE number, that's the Fed's favored inflation gauge, a broader measure than the CPI number, certainly. And PCE, core PCE, is the number we focus on. That came in at 0.13% in August, in line really with a 0.15 forecast, but of course that was rounded up to 0.2. So the headline, or not the headline, but the core PCE was slightly lower than that. 0.1% print, 0.13 to be exact, and lower than the 0.16 prior, which was of course rounded up to 0.2%. The year on year that rose 2.7%. But in line with forecasts. The annualized basis, actually 6-month rate, fell to 2.4%. That's the lowest since December, and the 3-month rate at 2.1%. All really suggests that the data is in line with the Fed's forecast, really. The latest median summary of economic projections sees actually core PCE at 2.6% by year end, and the headline at 2.3%. This again suggests sort of consumer prices are on track to hit the 2% target, the Fed's 2% target, that is, very soon. And adding that, the key drivers of inflation suggest underlying price pressures will continue to fade over the coming months. And you can just see that in this chart, of course, the headline and also the core numbers just closing in on that 2% Fed target. We also just should probably touch upon the RBA meeting as well. If I just pull up the Aussie dollar chart, which is of course hugely governed by risk sentiment, let's not forget that. But if I just show you the daily chart, first of all, the RBA did meet last week. As expected, they kept rates unchanged at 4.35%. They said growth was weak in Q2, but labour market conditions remain tight despite some signs of gradual easing. Certainly, though, sustainably returning inflation to target within a reasonable time frame remains the board's highest priority. Recent data have reinforced the need to remain vigilant to upside risk to inflation, and really the board is not still ruling anything in or out. There was actually an omission of any reference to a discussion of hiking in the statement, but generally they still remain relatively hawkish, and certainly relatively hawkish compared to other major central banks, and that certainly has helped the Aussie with this push higher, really, from obviously that spike low in the start of August up to really these key levels now that we're seeing. Just pull this chart back, you can see those highs from June and July last year, just below 69, 68.99, that high, and we're just sort of trading around there at the moment. Is this support before another push higher, or just major resistance and then we move lower? Interesting to see that other high, of course, as well, from December at 68.71. So a sort of pivot zone of support resistance potentially. If we do move higher, then we look to probably 70 and above there as likely targets for the bulls. Otherwise, below 68.71, then we probably get to these highs just above 68, and the 21-day moving average is at 67.84. Yeah, we did have actually inflation out of Australia as well last week. Actually fell for the first time to the target range of the RBA. That's the first time since October 2021. Printed in line with consensus at 2.7%. But really, the RBA will want to see a series of these sub 3% prints really for a few months before even considering easing. I think there is a chance of decent chance of a rate cut in December, but really I think most RBA watchers thinking they won't cut rates until the new year. Okay, also let's talk about the PMI data out last week briefly, just to highlight just the stagnation in the Eurozone, really. Business activity contracted sharply there, unexpectedly this month, really. The dominant services industry, that flatlined while we saw another downturn in manufacturing. Germany continues to lag, while France actually returned to contraction after the Paris Olympic boost. It was certainly a little bit of ray of light, really, with services inflation that eased with the lowest reading since April 2021. But otherwise, yeah, manufacturing still below, well below 50, has been for 2 years. And it's really this idea of stagnation at the end of Q3 which is playing into the hands of the doves really on the governing council at the ECB. Really, markets were pricing it only around a 35% chance of a probability of an October rate cut this month by the ECB, but now that's jumped really to, well, 70+% and above that now since the inflation data. Just briefly, US PMI data, that also disappointed actually, although services PMI did stay at robust levels, kind of alleviating recession fears. Just on Eurozone, continuing the data, we did get inflation data out yesterday, really key numbers for the ECB. As expected, actually, the headline that dropped to, well, rose 1.8%, so a drop from the previous 2.2%, I think it was, and below the estimate of 2%. That was the first time it is actually, well, at target or below target since June 2021. That was driven mainly by energy inflation due to base effects and certainly the monthly price declines we've been seeing in energy prices. Core inflation, the key number for the ECB, that printed at 2.6%. driven by, well, low goods inflation at 0.4% and then high services inflation at 4%. That is still possibly a worry for the hawks, of course. The ECB are focused on high services inflation, and that is an issue. Is 3.97% actually, so 4% in September, and that really remains a key upside risk for the inflation outlook. Otherwise, though, the recent momentum is showing signs of easing. President Lagarde did signal that in her recent press conference, but all in all, really supportive of this October rate cut. As I say now, odds actually after that inflation data now around 90%, I think, for another rate cut in a couple of weeks' time. If we just go to actually euro dollar, we have a chance to look at that. Because interesting sort of levels that we've breached. Again, major support level, just well, resistance level around the December spike high from last year. That's at 111.39. Of course, we got up to sort of just above 112, but again, big round number offered major resistance really to more upside. So 112, huge resistance. 111.39, an interesting point of reference really. Then we've got the 21-day moving average at 110.49, and we're just below that now and below 111 really, and just resting on this initial Fibonacci level, retracement level at 110.62. Below that then, otherwise we have 109.74. With also 110 being a point of interest as well. Of course, the main event of this week is non-farm payrolls data. Certainly that will be, euro dollar will be swayed by that release as well. If we just go to the graphic, first of all, which is here. So yeah, expectations on the headline for a 140k print around that. I think at the moment that will change through the week, obviously, as we get different employment data. That's against 142 in August, with the range 70 to 180,000. Remember to watch out for revisions. Certainly that will be a key area of note for markets. And there is a little bit of skepticism, I should say, around just these headline prints because of the revisions that we have seen. And certainly, if you remember that sort of 12-month revision by the BLS, which took sort of the total number of jobs down from the initially reported 2.9 million across those 12 months to March of this year. 2.9 million was revised down to 2.1 million. So the monthly really did change quite substantially. And in fact, it was, if you just bear with me 1 second, it was, yes, 2.9 down to 2.1, and the monthly then was changed to 178k from 246k. So interesting revisions, and certainly we've seen those over the last few months as well. So just watch out for those as well. Unemployment, that is expected to print unchanged actually at 4.2%. Remember that the latest Fed projection at the September meeting was for the jobless rate to rise to 4.4% by the end of this year. Average hourly earnings seen 1/10 lower from the 0.4 down to 0.3, pretty benign. An average work week hours seen unchanged at 34.3 hours. So the job gains, certainly they remain positive, but we have seen 4 out of the last 5 prints in the headline sub 150. Kind of still hanging in just about, but certainly we have seen a slowdown, of course, over the last 12 months as well. And compared to recent years, hiring expectations are now decreasing, which suggests that payroll growth may average around the 100,000 mark potentially for the remainder of the year. I've mentioned the recent revisions to look out for. They have undermined confidence in the data, while then surveys of hiring demand are deteriorating. And certainly as well in consumer confidence readings, we have seen, or they do point now to households really starting to experience a cooling economy. Consumer confidence in job security, that's dipping now, sliding slightly, and then that implies, of course, headwinds for consumer spending going forward. And certainly then potentially if we do get, we haven't seen major job layoffs, which has been an issue for economists, I know, but certainly if we do get those, then the unemployment rate could rise above that 4.4% target for sure. All in then, well, if we get a sort of headline print below 100,000 surely, and an unemployment rising to 4.3, 4.4%, then we will get prospects of swifter monetary policy easing. At the moment, the chances of another 50 basis point rate cut are seen, well, just under 40%, I think around 37% or so at the moment. Certainly though, last week they were up, and markets were favoring a 50 basis point rate cut over a 25 basis point cut at its next meeting at the start of November. Certainly, of course, obviously, with a weak report, we get those chances rising, and that will hit the dollar. Remember that the Fed is now squarely focused on the employment side of its dual mandate over and above prices and price pressures and inflation. That means, of course, a high sensitivity of the market to the details of the release. Of course, we might get a mixed report where we get a decent headline, but higher unemployment, or vice versa. And then we would see, of course, if we get a better report, then certainly the dollar will go higher and bounce off its major support level. If we just pull up that chart actually now, which is the dollar index here, you can see key level 100.61 really sort of tallies with the sort of 111.39 level we highlighted in euro dollar. Remember that in the dollar index, the euro has a big weighting, around 56%, way bigger than the others, the other 6 in the index. So if you flip this chart on its head, it's kind of the euro dollar chart. If I just show you, there we go. So yeah, 100.61 a key level. You've got the 21-day moving average, and we just moved above that at 101.01. So interesting move, but then certainly resistance, decent resistance, looks just below 102, around 101.88, and these previous highs from September. Okay, that is the dollar. We do get as well, just want to highlight, we do get, or we've had actually, ISM manufacturing data that was out yesterday. That was unchanged at 47.2, but we did get weaker sub-indices for prices and employment, but we did get stronger new orders. The inventory sub-index, actually, that also declined, but a combination of strong order books, as I said, falling inventories is kind of positive signal for demand. Also yesterday, and certainly to highlight, we do get a bunch of job numbers, of course, before the non-farm payroll number. We had jobs openings out yesterday, the JOLTS data that rebounded after ticking down in July, and past month's data was revised up slightly, but then the quits rate, the hiring continued to slow, although the number of involuntary layoffs also declined. So the reading really suggests labour market conditions not weakening that sharply, but the quits rate is of interest too. Certainly Powell has highlighted that as a key number he's watching out for in amongst the non-farm payroll data as well. We get, of course, initial jobless claims on Thursday. We get ADP today as well. Markets always look at that number, but typically it has very little correlation with the NFP headline number, just for your guide. Also, we get ISM services data out tomorrow. Expectations are for it to rise very marginally. Services obviously being the sort of main strength of the economy, and by far the biggest chunk of the economy as well, around 70% of it, whereas manufacturing just around 10% of the US economy. And again, watch out for services prices paid, which will be of interest, which in that data, which is released on Thursday, ahead, of course, of the main event. Okay, I think we'll wrap it up there. Short and concise, really. Yeah, lots going on, of course, with the geopolitical tensions. So watch out for that. The dollar getting a bid on that, of course, on safe haven demand. Potentially then that also helps the yen and the Swiss franc if that continues, whereas activity currencies like, of course, the Aussie dollar, the Kiwi dollar will get impacted if risk sentiment turns sour and those tensions increase. Of course, the flip side to that, and if things calm and the retaliation by Israel is certainly less than hoped for, then certainly Aussie dollar might break those key levels. The Kiwi could pick up, which did sell off actually quite sharply on disappointing domestic data yesterday. And then the yen and the Swiss franc may turn around and turn lower possibly, or the Swiss franc certainly, as it is a safe haven currency, or known as typically. Okay, we'll wrap it up there. Thank you so much for being on the call. It's great to have you. No questions, so really hope that is being clear to you guys. And yes, we look forward to speaking to you in a couple of weeks. Take care.